Hello traders, this is a Stray Dogs weekly video. I'm recording it on Saturday, and in this video I will go through the daily and weekly charts of DAX and US indices with some potential scenarios. So what we are looking at now is the DAX index daily chart. The week that we just had consists of these 5 candles here. We got a trend down day on Monday with a downside continuation on Tuesday, but support was not broken, and that was the key point of this week. Then followed by 2 smaller days, relatively smaller of course, on Wednesday and Thursday, and after consolidation and contraction, usually we got expansion. So this expansion led into contraction, then contraction led into expansion, and this time we got upside expansion on Friday. The scenarios that we had before were in the previous morning notes. For example, this green shaded text was from Thursday, and general scenarios for DAX were more ranging above support, meaning above this unfilled gap and this line here. It is all around 22,200, which could lead to the new all-time high if enough time is given. And DAX is ranging basically with making sharp throws up and down, literally going nowhere, sideways, but in a wide range for a month, because that gap was made between February 12th and 13th, so full month. Then next scenarios would be false breakdown of the support, so for example filling that gap but just a bit to go, just a bit under it, with a swift move back over it, like look below and fail, making a bear trap, and then up they go. Or decisive breakdown of the support and filling some of the gaps and poor structure below this. Why I'm saying poor structure? Because the structure from January pullback low up to this range here consists of many days with gaps. There are here 5 unfilled gaps, and from previous experience trading DAX for many years, I have found out that usually 4 unfilled gaps is good enough for market to start filling them. We still have 5 unfilled gaps because this gap here, price attempted to fill it 2 times. It was only partially filled. Now it's much smaller than before, but it's still there. It is still standing. Now, inability to break support. Let's go on futures. So this is not back adjusted DAX daily futures, and you can see it here. So this here is a February low, and this fib retracement was made on February low to February high, basically on February range, and 38.2 held. Also daily 20, which is the midpoint of the Bollinger Band, held for quite a while. Then we got a push below it, but again just to the support. So basically what we had here was 4 tests of the support where market showed inability to break that support, and basically after 3 trend down days it still held above support. So inside this consolidation we so far had at least 4 trend days. This one here was trend up day, and we could also call the one from Friday a trend up day, given the fact that it was a 640 point day on futures. So basically 5 trend days were made inside a consolidation. Now this is not the first consolidation which is a wide range and in which market just holding above support. We had those consolidations before, and if you zoom out your chart and go to the left, I think everybody who is are trading for a bit of more time can remember this consolidation here. For example, this was from 2024, but also some bigger ones like this here or this here lasted for 11 months before a breakdown occurred in February 2022. So market can go like this up and down, and to make those sharp throws up and down, and to make trend up or trend down days, and it is up to us traders to adjust to that volatility, to adjust to those bigger daily ranges. Now, one of the scenarios also, besides the one that I have just showed you on that green shaded text, was what if DAX as a leading market, he is holding, so it is holding support, while those weaker markets, which were in these periods were US markets, and they were going down. What happens if DAX, which is stronger and which is holding support, and then those weaker markets start to get a bid? Then if those weaker markets start to go up, and S&P was a weaker market, but also much bigger market than DAX. Remember that nowadays DAX is around 2% of a global stock market, while S&P is much bigger. And if S&P starts to find support because it was oversold and going down for days and days, what can happen with DAX then? And DAX is stronger. Obviously, that is going to be supportive for DAX, and that's exactly the thing that we got. Now, people can say S&P hit September 2024 lows, which is correct only if you look at continuous back adjusted futures contract. Now this is comparison with regular back adjusted contract and not back adjusted contract, on which you can see these rollovers between futures contract, and usually there are some gaps here between futures contracts. For example, this was one of the rollovers, and it is also something that people tend to watch these gaps here, and that is why people are using not back adjusted contracts. And also those not back adjusted contracts are closer to the index. They are much similar to the index, which is obviously mother of all other derivatives. As we can see on adjusted contract, S&P did test September 2024 low, poked a bit below, and up they go. Now when we zoom here on this, for example, not knowing about this, which we could do here as well, so S&P going down, gliding on the lower end of a Bollinger Band, this candle here would be Tuesday, and this what happened on Thursday was marginal lower low, and then regaining here Tuesday low, market just being able to make marginal lower lows, up they go, and squeezing. When we go to observe index, which I'm going to do on a combo chart of DAX and S&P weekly chart, we can observe on these weekly charts that both DAX and S&P are having big rejection tails on weekly candles from below, so-called buying tails. And look where that September low actually is on index, so much lower. And again, when we go back to futures back adjusted and not back adjusted contract, then you can see the difference. On back adjusted contract, they actually hit September low, while on not back adjusted, which is closer to the index, they didn't. So this here is actually like on index. Now, additional thing here to note, the weekly low, which landed on 5,504.65, is this low on index some random thing or not? Or is it just that they test September low button continuous contract on futures and nothing else? No. This, if you make a fib from August 2024 low like this, then ta-da, it was 61.8 as well. So why would you in the first place make a fib from here, because this is one of the dominant swing lows inside this channel. S&P was in this channel from October 2023, so quite a while, and this was one of the tests of those channels. And if you make a fib from this from prominent swing low up to the all-time high, which makes sense to make, then it was also a test of 61.8. So there were a few pieces of a puzzle, and even if you didn't look at the futures daily chart back adjusted, even if you didn't make this fib, just by observing price action and the market that is oversold and making just marginal lower lows, at some point they could regain some of those marginal lower lows and shoot higher with short covering. And the final thing which we also observe on these daily charts, market went down more than 10%. Now 10% is very important threshold, and it is always a very good idea when market goes down 10%. If you were selling from above, because here we had marginal higher highs as well on bearish divergence, and market went down sharply, and there are many much better entry points than to sell minus 10%. That 10% is something that many traders are going to use at least as a scale out point, if not as a target. Also, minus 10% is something that is very juicy pullback, which actually can motivate large time frame buyers to entry. And those large time frame buyers absolutely do not need to look at this at all or at this. They don't even need to apply technical analysis. They just can say, okay, market is down 10%, I'm scaling in longs, and that's it. Because the best possible gains for investors and traders that are trading from weekly charts were always to go long on bigger dips and to sit out bigger corrections and bear markets. Obviously, you need to have very big accounts to buffer out those corrections. And that is not for everybody. The same thing like day trading or scalping or swing trading is not for everybody. But always take note of those round thresholds, like minus 5%, especially minus 10%. Okay, so that would be it about comparing DAX with S&P weekly. Now let's observe those other US markets, because those other US markets also, you see Nasdaq, for example, also is having that rejection tail, and this is like a break below that upsloping trend line, which I already showed in the previous weekly video. This is Dow weekly, also rejection tail, and even Russell had a rejection tail. And where is that rejection tail? Right below these here prominent lows. In case of Russell, that would be August low. So Russell poked below August low, and the equivalent of August low on much stronger market like S&P would be this here. And you have seen on Russell, they almost went into the bear market. They actually went down somewhere between 19 and 20%. So what can happen next? Is this it? That's the million-dollar question. Is this it? Is correction over and now this is it, and now we only think about upside? Or not? Because you know how they like to say, quoting, buyers are not out of the woods yet. I think also the same. Buyers are not out of the woods yet. This is start, and this here obviously was a bad location for sellers. They are squeezed, but to get the ball really rolling, I think that this market needs to do more. I'll show you that on daily S&P chart. And I'm going to use blank chart for this because, as you know, my charts do have a lot of stuff going on there. And one of the scenarios would be this: a bigger pullback toward the bottom end of the election gap. You know, when President Trump came into the power for the second mandate, this was election gap. Price were leaning on daily 50, election gap, up they go, testing of the upper end of the election gap, there's partial fills, gap is holding, higher high, down again toward the same gap, again they didn't fill it. One of the concepts says big gaps likely will not get filled on a first attempt, and when we observe that gap on DAX, the one above we are trading for a full month, that's the same concept. Price tagged it 2 times, it was only partially filled. Here, price tagged it once, second, third time it was a gap fill and a huge bounce that went to make another marginal high, higher high, and above this we got higher high, and higher high, all marginal higher highs with bearish divergence. Down they go below daily 50, daily 50 then served as resistance, then daily 200 served as support on the first test. On the second test they went below it but regained it, and then they went down. So that's the history lesson. But what now? Now buyers, if they mean business, need to regain daily 200 because market is obviously negative below daily 200. To regain daily 200, they would need to tag November lows, right? And to go above all of this here and above this. So they need to regain both November low, January low, and to go back above this level, which is the lower end of the election gap, which means in levels above daily 200 and then above 5,770 and this 5,782. About these levels here would likely be more squeeze over sellers. For now, we should suspect that if they continue to push higher, that this level around daily 200 and those two mentioned levels should act as resistances on the first test and then to observe price action. Also, if those markets which were up to this point lagging markets continue to go higher, especially S&P, then we could expect from DAX, which is already stronger and which was stronger in all of this move, which is stronger for months and months, to go toward all-time high and potentially make new all-time highs. So those are scenarios, and we are watching DAX traders always to watch S&P for correlation purposes and for those signs, signs around the road or at the road, so to speak, to get some info and some insights what that currently lagging but still much bigger market is doing. Okay, so we can obviously get more trading inside this, and potential catalysts that we are having this week would be a bunch of central banks like Bank of Japan Day, FOMC Day, SNB Day, Bank of England Day. From all of that, FOMC Day, the most important one, then Bank of Japan can be some surprise. SNB Day is usually with timing around 9:30, meaning in the first half an hour of regular trading session for DAX, and there could be some knee-jerk moves, unlikely to be something big, but knee-jerk moves, yes. Bank of England, probably no influence on DAX whatsoever. So eyes would be on Wednesday and on FOMC day. No rate change is expected. Therefore, if that is the case, really no rate change, then press conference and further guidance that Powell is going to give, that is something that could kick the markets up to Wednesday. Everything is going to be likely positioning of market participants for the FOMC. Okay, so that would be it. I'm sorry, for this edition of Stradox Weekly Videos. And as always, I wish you a pleasant weekend and good trading.